October 1929. The world was about to change forever. In just a few days, the stock market, what seemed like an engine of endless prosperity, would collapse in the most devastating crash in American history. Life savings, built up over years of hard work, just vanished. Paper millionaires became paupers overnight. The dazzling optimism of the Roaring Twenties dissolved into the bleak breadlines of the Great Depression. But here's the thing. While millions of lives were being ruined, a handful of men walked away from the wreckage with insane amounts of money. One trader, a guy they called the Great Bear of Wall Street, supposedly pocketed over $100 million in a single week. In today's money, that's over $1.5 billion. While the world burned, these men weren't just holding a fire extinguisher, they were selling the water. This is the story of how they saw it all coming, and how they used one of the riskiest moves in the book to profit from a financial apocalypse. Section 1. The Roaring Twenties, a party on thin ice. To really get the crash, you first have to understand the wild party that came right before it. The 1920s in America were a decade of explosive optimism and economic growth. World War I was over, and mass production was fueling a new kind of consumer culture. For the first time, more Americans lived in cities than on farms. Cars, once a total luxury, were becoming common thanks to affordable models like the Ford Model T. And in more than 12 million homes, radios crackled with the sounds of the jazz age. Wall Street was the heart of this new, booming America. The Dow Jones Industrial Average went on a 9-year tear, increasing in value sixfold. It really seemed like everyone was getting rich from stocks, and thanks to a new, dangerously easy type of credit called margin. You didn't even need to be rich to play the market. Brokers would lend investors more than 2/3 of the cash they needed to buy stocks. By 1929, over $8.5 billion was out on loan just for stock speculation. That's more than all the physical money circulating in the US at the time. This created a massive economic bubble. It was a national obsession, fueled by this shared belief that the market could only go up. The nation's total wealth more than doubled between 1920 and 1929. One leading economist, Irving Fisher, famously declared that stock prices had reached what looks like a permanently high plateau. But a few sharp minds saw the truth. The party was about to come to a very violent end. They saw that the wild speculation had nothing to do with the real economy, where key sectors like farming and manufacturing were already flashing warning signs. Section 2. The Bears Emerge. Reading the storm clouds. But not everyone was drinking the Kool-Aid. And among the skeptics, one name stands out: Jesse Livermore. Born into poverty, Livermore was a self-taught trading genius who started his career at just 14, chalking up stock quotes on a blackboard. Livermore never had a fancy education, but he had something better, an almost supernatural feel for the market psychology. He could practically smell the greed and the fear. He believed the market was all about human emotion, and he saw that emotion tipping into pure, irrational delusion. Livermore wasn't just guessing. He was a master of technical analysis. He stared at stock charts relentlessly, looking for patterns. He knew you should follow the big trend. But more importantly, he knew how to spot a pivot point. That exact moment a trend is about to slam into reverse. In the months before the crash, Livermore started seeing disturbing signs. The market's biggest, most powerful stocks, the ones that had led the charge for years, were starting to sputter. While everyone else saw a temporary dip and a chance to buy more, Livermore saw the beginning of the end. And this is where he used a strategy that would make him a legend: short selling. Put simply, short selling is betting that a stock's price will go down. Here's how it works. You borrow shares of a stock from a broker and sell them immediately at today's price. The plan is to wait for the price to fall, then buy those shares back at the new, lower price and return them to the broker. That difference between where you sold and where you bought back, that's your profit. Now, short selling is incredibly risky. If you buy a stock, the most you can possibly lose is what you paid for it. But when you short a stock, your potential losses are, in theory, infinite, because there's no ceiling on how high a stock price can climb. Stimulate against the entire market, especially one as hot as 1929's, took unbelievable courage and conviction. As the market hit its all-time high in September 1929, Livermore began building his short positions, quietly betting millions against the entire American economy. Section 3. The climax, Black Tuesday. The first real tremor hit on Thursday, October 24th, a day we now call Black Thursday. Panic selling started. A record 12.9 million shares were traded as investors scrambled for the exits. Things got so crazy that a group of Wall Street's most powerful bankers, guys from JP Morgan and the like, literally pooled their money to start buying up huge chunks of stock just to stop the bleeding. It created a brief recovery, but it was just a band-aid on a bullet wound. Confidence was shattered. Over the weekend, the panic went from Wall Street to Main Street. On Monday, October 28th, the market plunged again, falling almost 13%. Then came Black Tuesday, October 29th, 1929. It was the day the dam finally broke. A tidal wave of sell orders swamped the New York Stock Exchange. The ticker tape that displayed stock prices fell so far behind it became useless, which only added to the terror on the trading floor. 16 million shares were sold, smashing the record set just a few days before. The Dow dropped another 12%. In just 2 days, the market had lost roughly a quarter of its value, vaporizing billions of dollars. But while the trading floor was filled with screams and despair, Jesse Livermore was reportedly a picture of calm. He'd been waiting for this. As the panic selling got worse, the value of his short positions soared. Every point the market dropped was another $1 million in his pocket. While titans of industry were wiped out and small-time investors lost everything, Livermore was methodically closing his positions, cashing in on the catastrophe. When the dust finally settled, he had made a fortune of over $100 million. And he wasn't the only one. Joseph P. Kennedy, the father of the future president, also came out of the crash richer than ever. His strategy was a bit different, though. Kennedy wasn't a chart guy like Livermore. He was a smart businessman. The famous story, which might be an anecdote, is that Kennedy knew it was time to sell when he started getting stock tips from a shoeshine boy. His logic was simple. When absolutely everyone is speculating, you're in a bubble. He believed Wall Street was dangerously overvalued, so he sold most of his stocks before the collapse. So, not only did he save his own money, but he also got into short selling, making a profit on the way down. Stories like these show you a side of the market that most people never see. That for every catastrophic loss, there's often a calculated gain on the other side. Understanding these strategies and the psychology that drives them is one of the keys to figuring out how wealth is really built and protected. If you found this deep dive into financial history as fascinating as I do, make sure you're subscribed and hit that notification bell so you don't miss what's next. Section 4. The Aftermath. A Tale of Two Americas. The fallout from the crash was brutal and immediate. The financial collapse set off a chain reaction of failures. Businesses shut down, credit vanished, and thousands of banks, which had also been gambling with their depositors' money, went under. By 1932, the stock market had lost a mind-boggling 90% of its value from the 1929 peak. Unemployment shot through the roof. At its worst, over 20% of Americans were out of a job. The Great Depression had begun. For most people, it was a time of unbelievable hardship. But for the few who bet against the market, it was a golden age. Jesse Livermore became a Wall Street legend. The Great Bear. Joseph Kennedy's fortune exploded. He went from an estimated $4 million in 1929 to $180 million by 1935. He used all that cash to snap up struggling businesses and real estate at rock-bottom prices, laying the foundation for a political dynasty. Other sharp investors like Percy Rockefeller and William Danforth also pocketed millions by shorting the market. Their success was a bitter pill for a public that felt, correctly, that the system was rigged against them. The public outrage against short sellers got so bad that President Herbert Hoover condemned them, and the government launched investigations into their role in the crisis. This public outrage eventually led to new rules designed to prevent these kinds of bear raids, where short sellers could aggressively crush a stock's price. Conclusion: the contrarian's edge. So what's the takeaway from the guys who got rich in the 1929 crash? It's more than just a story about smart investing. It's a powerful lesson in market psychology, risk, and the guts it takes to be a contrarian. What really separated Livermore and Kennedy from the millions who lost everything? First, they ignored the madness of the crowd. They understood that markets are driven by two simple emotions: greed and fear, and they knew when greed had become a collective delusion. While everyone else was chanting that the party would never end, they were listening to the quiet warnings of economic reality. Second, they mastered a specific, high-stakes strategy. Livermore's fortune came from his deep understanding of market trends and the mechanics of short selling. Kennedy's came from his fundamental judgment of value and, just as importantly, knowing when it was time to get up and walk away from the table. And finally, they had incredible discipline. Livermore was ruthless about managing his risk, and he was known for cutting his losses the second a trade went against him. It was that discipline that let him survive long enough to make his legendary bet. The 1929 crash is this brutal, timeless reminder that in finance, fortunes aren't just made when things are going great. Sometimes, the biggest opportunities are hiding in plain sight, right in the middle of total chaos. They're just waiting for someone with the vision to see the disaster coming, and the audacity to bet on it.